Your bank doesn't want you wealthy. They don't even want you comfortable. They want you just unstable enough to keep needing their high cost products, just broke enough to keep paying fees, just stressed enough to make profitable mistakes. And there's one specific threshold that changes this entire dynamic. I am your Mr. Brother, and today I'm breaking down why $20,000 in savings completely transforms your relationship with money and why financial institutions lose money the moment you cross this line. Think about what life looks like when you're sitting below $20,000 in savings. You're running mental calculations constantly. Do I have enough for groceries after filling up the tank? Which bill can I delay without getting hit with a late fee? How many shifts until my next paycheck? Every surprise expense triggers panic. Transmission fails? Financial emergency. Root canal? Household disaster. HVAC system dies in July. You're scrambling for solutions. You're living one crisis away from spiraling into credit card debt, one layoff away from eviction, one medical bill away from years of financial recovery. This isn't financial planning. This is financial survival mode, and roughly 60% of Americans are operating this way right now. But here's what the financial industry doesn't advertise. There's a specific dollar amount where everything shifts, where the constant anxiety fades, where unexpected expenses stop feeling like catastrophes, where you finally get breathing room. That magic number, $20,000. Not six figures, not even $50,000. Just $20,000 sitting in an account fundamentally changes how money works in your life. Here's why this number matters. For most households, $20,000 covers 4 to 6 months of baseline expenses. That's not a theoretical emergency fund. That's real financial cushioning, not the token $1,000 buffer personal finance gurus mention. Actual protection. With $20,000 backing you up, you can absorb virtually any single financial shock without borrowing. Totaled car, covered. Sudden unemployment, you've got runway. Emergency surgery, manageable without credit cards. The perpetual low-grade anxiety that hums in the background, it finally goes quiet. Your sleep improves. Your stress level drops noticeably. But here's what makes this really fascinating. The moment you hit $20,000, you stop being profitable to your bank. And that really bothers them. Let me break down exactly how financial institutions extract money from people living below this threshold. Revenue stream 1. Overdraft charges. American banks collected $7.7 billion from overdraft fees last year. That's billion with a B. Every penny came from accounts that dipped negative. Your balance drops $3 below zero. They charge you $35. You literally paid $35 because you were short $3. If multiple transactions hit while you're negative, they stack those fees. Some people get hammered with $100 or more in fees in 24 hours. When you're carrying $20,000 in savings, overdrafts become mathematically impossible. That cushion ensures coverage always exists. Your bank extracts $0 from overdraft fees. They genuinely hate losing this revenue. Revenue stream 2, emergency lending. When you're desperate for fast cash, your options are predatory. Payday lenders charging 400% interest, car title loans threatening to seize your vehicle, personal loans with brutal rates, credit cards at 29% APR or higher. Financial companies love desperation. Desperate borrowers pay whatever the cost without shopping around or negotiating. They need money immediately and can't afford to be selective. With $20,000 saved, desperation never enters the equation. Need $2,500 for an emergency? Transfer it from your savings account. Zero interest charges, zero origination fees, zero profit for the bank. This makes them genuinely angry. Revenue stream 3, revolving credit card balances pay over $1,000 annually in interest on average. That's $1,000 going to banks for providing nothing except debt. People below the $20,000 mark frequently carry balances month to month because they can't cover the full statement. They're treating credit cards as emergency funds. They're making minimum payments while interest compounds relentlessly. When you've got $20,000 saved, you pay credit cards in full every billing cycle. You extract the rewards programs while paying zero interest. The credit card industry actually has a term for customers like you: deadbeats. That's genuinely what they call people who use credit cards without generating interest revenue. They want you perpetually in debt, not sitting on a healthy savings balance. Revenue stream 4, maintenance fees. Most banks charge monthly fees for checking accounts, but waive them if you maintain specific minimum balances. Typically $1,500 to $5,000 or more. People living paycheck to paycheck struggle to maintain those minimums consistently. Income arrives and exits immediately, so they pay $12 to $15 monthly just for account access. That's $150 to $180 annually to hold your own money. With $20,000, you easily clear every minimum balance requirement permanently. Monthly Monthly fees disappear, maintenance charges vanish. Another bank profit stream evaporates. Revenue stream 5, stress-induced bad decisions. This is psychological but financially devastating. Financial stress destroys decision-making quality. You impulse buy for temporary emotional relief. You accept terrible deals because you lack time to research alternatives. You agree to predatory financing because you need something immediately. Financially stressed people generate maximum profits. They're susceptible to pressure tactics. They're easy to manipulate. They're revenue generators. With $20,000 saved, you make financial decisions from a position of calm. You can refuse bad offers. You can wait for better pricing. You can negotiate confidently. You can simply walk away. That financial buffer doesn't just shield you from emergencies. It protects you from your own panic-driven choices. It creates the mental space for rational financial thinking. Here's the psychological transformation that happens at $20,000. Below that threshold, you operate in scarcity mode. Every choice centers on survival. Can I afford this? What if everything goes wrong? Better play it safe. Scarcity mentality is mentally exhausting. You're constantly calculating worst-case scenarios. You're perpetually worried you can't think long-term or take strategic risks because you're buried in daily financial crises. Above $20,000, you shift into opportunity mode, not billionaire abundance, just basic financial stability abundance. You can accept the lower paying job with better career trajectory. You can leave the toxic work environment because you've got a safety net. You can negotiate aggressively because you don't desperately need any particular deal. Every opportunity transforms when you have real options, and $20,000 creates real options. Consider this scenario. Your manager treats you terribly. You know you should quit, but you're living paycheck to paycheck. With zero savings, you're completely trapped. You must tolerate mistreatment because missing even one paycheck would be catastrophic. Your manager understands this power dynamic. They can behave however they want. With $20,000 saved, you can resign immediately if necessary. You've got months of financial runway for job searching. Your manager's power over you just completely vanished. Identical job, identical terrible boss, radically different power dynamic, all because of that financial cushion. This principle applies universally. Buying a car, negotiating rent, discussing salary, evaluating business ventures. Without savings, everyone has leverage over you. With $20,000, you have leverage over them. So how do you realistically reach $20,000? I know it feels impossible starting from zero or from negative if you're carrying debt. Let me simplify the path. Step 1, identify your monthly margin. Examine your income versus expenses. Can you find even $100 monthly of gap? That's your foundation. No gap exists. You must either reduce expenses or increase income. There's no shortcut here. Step 2, automate the process. On payday, money should automatically transfer to savings before you see it or can spend it. Could be $50, could be $200, whatever works. Step 3, reclassify savings as non-negotiable. Your savings contribution isn't optional leftover money. It's a mandatory bill you pay to yourself first, as essential as housing costs. Step 4, redirect all windfalls completely. Tax refunds, work bonuses, gift money, everything goes to the $20,000 goal, not to purchases, not to trips, to the goal. Step 5, eliminate one thing you don't value. Everyone has at least one subscription or recurring expense they genuinely don't care about. Find it, cancel it, redirect those dollars. If you save $400 monthly, that's $4,800 yearly. You'll hit $20,000 in roughly 4 years. That feels slow, I understand. But those 4 years will pass regardless. You can reach 34 with $20,000 in the bank, or reach 34 in exactly your current position. Here's what happens once you start. Momentum builds naturally. You become obsessed watching that balance grow. You discover additional savings opportunities. You get raises and actually save them instead of increasing lifestyle expenses. Most people committed to this process reach $20,000 faster than they initially expected. And once you arrive, everything shifts. Stress decreases dramatically. Opportunities multiply exponentially. Banks stop profiting from your existence. You transform from being a financial product into being an actual customer. From being exploited to being respected, $20,000 isn't the finish line. It's not retirement money or generational wealth, but it is the first genuine milestone, the point where the entire game changes. Below $20,000, you're playing pure defense, just surviving, reacting to emergencies. Getting squeezed by fees and interest and desperation pricing. Above $20,000, you can finally play offense. Build actual wealth, take calculated risks, make decisions from strength rather than fear. Your bank designed their business model around keeping people below this line. They extract profits from your stress, your emergencies, your desperation. Every dollar you add to savings is a dollar they can't extract through fees and interest. Every step toward $20,000 is a step away from being their ideal profit center. Make them hate you. Get to 20K if this video showed you why this threshold matters. Hit that subscribe button. Comment below and tell me your current savings number and where you're headed. All right, go build that buffer. I'll see you in the next one.